So for those of you not familiar with investment presentations, the first slide is always the most interesting. It's the disclaimer slide. Basically what this says is that investing is inherently risky and you can actually lose money doing it. And we'll be discussing projections as well, so I'll use words like should or might. And again, before taking any action, you should speak with a registered investment advisor. So today we'll be discussing using Hadoop for something that I refer to as Finance 2.0, in contrast to Finance 1.0, which I'll also discuss during the presentation, and how Hadoop is improving investment performance. So this first slide appears extremely basic, but in reality, it can explain probably 90 or 95% of finance and financial market theories in general. Essentially what happens is information gets generated in a variety of forms. The markets, depending on what kind of analytical techniques are used, decide which parts of that information is relevant, and then a variety of analytical techniques are used, and the output is price. Now, theoretically, what's going to happen if the amount of information changes, the types of information change, or even the speed of information, that's going to change the form of analytics, and that's going to have an impact on price. So normally what happens is when information is stable, the types of information are stable, and also the types of analytics are relatively stable over time, then tradition tends to prevail. And what's meant by tradition here is decades of academic research, textbooks, all the things that people learn in graduate school or in higher education. Those types of analysis and theories tend to perform very well. And this isn't only for finance, this is for pretty much any sector. Now, what happens when the amount of information, the types of information start to increase? We get thrown into these disruption periods when the traditional forms of analysis start to break down, and whether participants want to or not, they're dragged into the new forms of information, new forms of analysis. Now, it appears like what's happening right now in finance is that they're incorporating a good portion of the data, but not all of it. So you literally have an explosion of information, new forms of information. And going back to that first slide, if you don't incorporate all of the information effectively and adapt to these new analytical techniques, you're not going to get the pricing right. So in these market phases, when things are relatively stable, participants gain advantage through things like accessing networks. And it's no coincidence that in finance, the focus of decisions are made in a fairly small number of cities, and even within those cities, very small neighborhoods. And again, that goes back to the idea that you gain advantage through privileged access. Faster access to information. Over the last decade, a massive amount of money has been invested to get information quicker. Laser focus, a lot of funds focus on very small portions of the market. But during disruptive periods, which I believe we're in right now, it's a sea change. So investors gain advantage through looking at those new forms of data, applying new forms of analytics, and by innovating. And again, this isn't just for finance. I mean, a lot of what I'm discussing can be applied to different sectors. So traditional finance, or Finance 1.0, revolves around three very broad areas. One is fundamental data and analysis, the other is macroeconomic data and analysis, and the third is technical data and analysis. So fundamental data, you can think of things like balance sheets and income statements. Macroeconomic, things like inflation, figures, unemployment, and technical is pricing and volume for the most part. I mean, I'm generalizing a lot here. Finance 2.0, which has really come about in the last 5 to 10 years, but is starting to gain steam, include things like social media. A lot of people have done research on things like Twitter feeds, quantified or machine-readable news, Search terms, web mining is a world unto itself, so really you're just restricted by what you consider to be relevant. There's obviously a lot of data out there, and location or geolocation data. And again, I'm generalizing a lot here. So the Finance 1.0 data is extremely structured, and it's extremely well standardized. And the standardization part is probably something that people really haven't focused that much on in the past. So for things like balance sheets and income statements, you know months in advance exactly when that data is going to be released and the format that it's going to be released in. You know 95% accuracy, the line items. Macroeconomic releases, the same thing. You know probably a year in advance when a lot of these macroeconomic releases are going to occur. And technical information, the exchanges globally are extremely well standardized at this point. This is in contrast to Finance 2.0. The data is extremely unstructured and extremely messy data as well. And because finance doesn't yet have a slew of textbooks and academic research going back decades on what to do with a lot of this data, you don't want to fit it into necessarily relational databases where you really have to figure out the schema beforehand. And what this amounts to is that the tools for analyzing this data are changing quite rapidly. So the Finance 1.0 infrastructure relied primarily on relational databases, whereas the Finance 2.0 is going to revolve much more around Hadoop and multi-stage or multi-level architectures. So next we'll be looking at some examples of Finance 1.0 and how they're going to be improving, how Finance 2.0 compares and should improve Finance 1.0 techniques. So we'll look at a top-down approach. So top-down meaning index level bets and performance in general, so how investors are doing in general. Bottom-up relates to company level analysis or company level data, literally looking at things from the bottom up. And then fundamental data is slightly different. There we'll be looking not at pricing performance, but how Finance 2.0 techniques can be used to improve traditional Finance 1.0 analysis. So this slide is fairly depressing, frankly, for those in the financial markets, and I guess even worse for investors and hedge funds. But what this slide shows is a hedge fund index divided by the S&P 500. So the fact that this is trending fairly consistently down since the low of the bear market in 2009 states that hedge funds on average are underperforming the stock market. So there could be a variety of explanations here. My explanation is that the economy is changing. There's a lot more information out there. The hedge funds in general are still within the Finance 1.0 paradigm. They're focusing on exclusively that information, that data, and those type of techniques, and it's not producing the returns that they should. This next slide again shows what amounts to financial elites, which are investment strategists. The yellow line is the recommended equity allocation, the average recommended equity allocation of investment strategists on Wall Street. So the higher the line is, the more bullish they are on equities, and the lower the yellow line goes, the more bearish they are. And you can see at in 2012, there was a drastic collapse, actually, in the recommended equity allocation. And that was in contrast to what happened in the market. The market took off. It almost went vertical by the end of 2012 and into 2013. So again, what we've seen here is, again, I'm assuming that investment strategists on Wall Street are mostly using quote unquote historically proven techniques and data, and they're providing incorrect signals. So what we've seen so far, hedge funds are massively underperforming, which they didn't used to, and investment strategists more recently are making very poor calls on the stock market's direction. And this is in contrast to a mood index. This is something that we've developed internally. The idea is very simple. When it's pointing up, it's bullish for global equities. When it's pointing down, it's bearish for global equities. And because the series is a little squiggly at times, we created another fairly basic algorithm to determine the strength of the trend. You can overlay the, here is the S&P 500, but you can pretty much put other global indices as well. You create inversions that don't happen very often. You take away the mood index, you're left with a fairly basic trading strategy, or investment strategy. I guess it's not a trading strategy. But one of the important points here is that there are a lot of people who are using Finance 2.0 information, and I don't know the exact number, but by far the majority use it for short-term trading. So things like short-term sentiment trades. They'll use like Twitter feeds. And I think if you ask most people how to apply Finance 2.0 or new data to investing, they'll relate that to some kind of very short-term, very short holding period strategies. And what we've done is exactly the reverse. What we've done is shown that Finance 2.0 can actually create by itself, not incorporating stock prices or income statement, balance sheet data, or macroeconomic data, very good calls. And the last call was just about a month ago. To this point, the markets have been struggling. There was a bit of a scare about a week ago. It's starting to come back a little bit, but and normally these calls go for months to over a year. So we'll see how things unravel from here. Another interesting point, comparing the mood index against the recommended equity allocation. This is what I was referring to earlier when the recommended equity allocation fell off a cliff and the mood index started to trend up. So there does seem to be a difference between Finance 1.0 and Finance 2.0 conclusions. So why is this occurring? Again, it relates back, I believe, to the disruption that's occurring right now within finance, but within the economy in general, which relates to there's a lot more information. It's much more of an information-based economy. Unfortunately, financial market participants are experiencing information overload, and there's too much of a reliance on these traditional techniques. So for the bottom-up example, we'll look at a single stock example. This is Netflix. So for a good period of time, Netflix was a stock market darling. It performed extremely well. Analysts, portfolio managers, consumers, everybody loved the stock. And then they came out with a press release, which I'm not sure if many of you remember, but they changed their pricing strategy. Now, the traditional finance reaction to this was, for the most part, neutral to positive, and we'll see some examples of that. And one of the reasons being that if you increase price, your revenue is going to increase, margins increase, earnings increase. So that's a very traditional 1.0 analysis. This is the stock price. The press release came out on July 12th. On July, whoops. Okay. On July 13th, the stock actually made a new all-time high. So July 12th, the press release came out. The stock closed up on the day. The next day, the stock made a new all-time high. So the traders did not think that this was particularly bad news. Another way of seeing if this is relevant or not to a trader is to look at the traded volume, which is the bottom. And there wasn't a spike in traded volume either. So the traders' reaction in general was that this was not a relevant event, or at least not a negative event. The analyst reaction, analysts versus traders. Analysts have longer-term holding periods. They tend to do more fundamental type analysis. Their reaction was neutral to positive as well. So a lot of analysts either maintained or increased their target prices. These are just quotes from the period. And even Jim Cramer, I think about a week or 10 days after the press release, was saying that it was a good time to get into the stock. So in general, what we saw in this one example is Finance 1.0 said, yeah, it's not that bad. The price closed up, the stock price closed up. There wasn't a large explosion in trading volume. Analysts came out neutral to positive. Consumers saw the exact same announcement, and they didn't react the same. They became very upset. And one way of viewing this is Facebook comments or social media in general. So those traders incorporating something like a Finance 2.0 could have set up alerts so that if comments exceed, let's say, 1,000 or 1,500 or 2,000 or exceed some kind of moving average, they would at least get some kind of an alert. Now, what happened is the number of comments on the Facebook page eventually hit 80,000. So it just blew through everything that had happened in the past. This is a massive occurrence in social media. And this Netflix example is probably one of the first true examples of Finance 1.0 against Finance 2.0. And then looking for other confirming data series, this is what happened on Twitter for Netflix. Again, you would assume that the tweets and the Facebook comments would more or less look similar. This is something interesting that most people don't look at, Wikipedia page views. And Wikipedia has a very deep bench of data that's applicable for financial markets. And the reason being is that if a consumer is upset, they could easily go to Twitter and complain, or they could easily go to Facebook or some other medium and complain. But Wikipedia is completely different. Wikipedia, if you see a spike in page views on Wikipedia, essentially it's a different demographic. Those people are looking to do research on whatever the company is, wherever the topic is. And Wikipedia is a neutral source of information, and it's a running history of whatever the topic is or company is. So if what happens on Twitter or Facebook or in social media in general is not going to make a large impact on the company, then you're probably not going to see a confirming influx on Wikipedia. And what we saw was there was a high number of edits, meaning changes on the Wikipedia page. So even if you didn't actually read the press release and you didn't read what was going on, these things should tell you there's a lot of changes going on in Wikipedia. People are going in and making edits. There's a lot of page views. There's a spike in tweets. There's a spike on the Facebook comments. So again, in contrast, the Finance 1.0 reaction, which was extremely muted, looking at very basic Finance 2.0 data, should have alerted traders that this was relevant. One other thing that I thought was interesting, there was a lower spike at the beginning of July, both for tweets and Wikipedia page views, but there wasn't a corresponding spike in edits. So, and there wasn't a large impact on the price of the stock either. So that's of interest as well. Another thing that normally happens during very controversial periods in a stock is you get anonymous edits. So on Wikipedia, you can either declare who you are when you make these edits, or you can remain anonymous. And right around controversial periods of in a company's history, you start to see these spikes in anonymous edits. And then, very similarly, you can use some NLP techniques to look at the comments made by the editors. So every time a contributor makes an edit to the Wikipedia page, they can leave a little comment saying why they made the edit. And a lot of times it's very simple, like poor punctuation or something. But other times they'll actually claim vandalism. So they'll assume that whoever went in before them, they were attempting to vandalize the page. And a lot of times it can be something very basic. Like in this case, some of the quote-unquote presumed vandalism were links pointing to articles discussing the consumer outrage. So when you start to see a lot of controversial things happening on Wikipedia, again, backed up by spikes on social media, you can be fairly confident that there's something significant going on. So what we saw here was Finance 2.0 against Finance 1.0 for both top-down and bottom-up. And what we'll discuss next. Oh, okay. So what actually happened with the stock price? So the target price is where the analyst thinks the price is going to go. The white is the actual stock price, right? So the top-ranked analyst at the time actually increased his target price, and it remained up for about a month. And the actual result was a collapse in the stock price. And soon afterwards, the target price collapsed as well. So my point here is not to rail too much on analysts or individuals. It's simply that by incorporating more information, more relevant information, investors should be able to get better analysis and better signals going forward. This slide needs some explanation. I think the title is slightly off. It should really be ROA, which is return on assets of the top 10 companies with the most aggressive hiring versus the lowest 10 companies with the lowest hiring. So essentially what we did is we analyzed the S&P 500 on a sector basis. We went to their sites and took the job offer data. We created indices on how aggressively they're hiring, creating ratios against how many employees they have, and all this is public data. Took the top 10 of those companies with the most aggressive hiring policies, and took their average return on assets. And we did the same thing for the lowest in each one of these categories. And what you basically see here is that the companies with the most aggressive hiring have higher return on assets. And this is not as high profile an example of that we saw in the first two examples where hedge funds are underperforming and investment strategists are underperforming, and you've got this thing called the Mood Index, which is doing quite well, and it's only based on new data. Or the Netflix example. Those examples are much more high profile. This is a very low profile example, but I think in the long term, this might actually be more relevant because the markets nowadays will literally stop when macroeconomic job data is released. So if unemployment numbers are going to be released in 10 minutes, everybody stops. Everybody stops and waits to see what's going to happen, or jobless claims, everybody stops and waits. Those data releases are lagging. So by the time that data is taken from a variety of sources, aggregated, and released, that data is already backward looking. A much more effective way of doing the exact same thing is going to the source data, which are the companies. This data is available online. Grabbing that data, doing analytics in quote unquote real time, and then you can use this data both from a bottom-up perspective to improve finance 1.0 analytics from a company perspective. Or you can aggregate the data into top-down indices, which would be very similar to a hiring index on a national level instead of waiting so much for these macroeconomic releases. So the main point here is that it's not going to be finance 2.0 and these new data sources. It's not just about beating the market and creating better algorithms. It's allowing traditional techniques to improve themselves. And this slide is essentially the same as the last one, except for its differential, the strong versus the weak. I'm not 100% sure why energy is off. So for the conference, I conducted a small survey, and one of the questions was, where do you think the bulk of finance-related innovation will come from over the coming years? And it wasn't on purpose, but I divided, I gave 10 options, 5 of which fall pretty neatly within the finance 2.0 category, and the blue fit pretty nicely within the finance 1.0 category. And the results show that market participants in general are expecting by far the majority of innovation over the next few years coming from these Finance 2.0. So big data analysis, machine learning, social media analysis, new forms of data, and news analysis, or machine readable news analysis. And they're not expecting that much innovation from the traditional Finance 1.0 techniques. And that's it. I ran through the presentation pretty quickly. So if there's any questions.
Great presentation, fascinating.
Thanks.
Just a quick question on the Wikipedia views, right? I get the edits, that people might be venting and vandalizing the pages, and that's a good indication of maybe negative sentiment.
Right.
What do you actually, what do you ascertain by just views?
Just plain views?
Yeah.
Well, it's traffic on the page. Like if something very significant were to come out in a stock, and let's say I'm an investor, but I'm not a full-time analyst. One of the first things I'm going to do is do some basic research. I'll do a Google search, and normally the first or second thing that comes up is the company's Wikipedia page. So if I see a large news item or event that I think is relevant, I'm likely going to go to the Wikipedia page and just do a brief overview.
But how does that tell you as an investor, who's looking at that data point, whether you might want to buy or sell?
Right. So I didn't get into it here because it's been done before. But you can look at the sentiment from social media, right? So I guess I didn't get into it, but there was a massive spike in social media mentions and comments, and those comments were overwhelmingly negative. So a very simple sentiment analysis should tell you which direction that relevance is going to point in.
So you basically use that data point in conjunction with other data points to know what to do with it.
Yeah.
Okay, thanks.
I could have expanded on that point. And it's not just sentiment. You can get into things like topic identification. You can identify what people are discussing, what other relevant events are occurring around that period, like did the earnings just get released? Was there a recent press release, right? Was there a news story on some potential merger, or did a merger actually get announced, right? So that it's not just sentiment, but essentially you can determine the direction by looking at the sentiment.
Yeah. Okay, cool, thank you.
Hi, a couple of questions. So you said you analyzed Facebook comments. How did you get that information? Like on the Netflix?
Well, how do you get the information?
Yeah, the comment. Do they publish
Yeah,
the number?
I mean, you can get the information through an API.
The Twitter, okay, so I was not sure. Twitter definitely has a public API, but Facebook, does it have a public API where you can figure out the comments, how many comments are made? That I was not aware.
Yeah.
Okay. And the other analysis you have done, so in general, what type of tools you used? Hadoop particularly, what type of machine learning, Mahout, anything like that, or what kind of technologies you used? And the other question is, are there any open source financial, software available doing this social networking analysis, those type of things?
Yeah. I think the best place to start are the general open source projects. So Hadoop, HBase is very good for time series. Hive, or any of the different incarnations of Hive.
No, I'm aware of the technologies. I'm interested more in the application. I'm the technical infrastructure guy, but I'm more interested in the applications. Are there any GitHub, open source already some examples where I can start looking at get started on analyzing tweets related to stocks, for example.
I'm not 100% sure. You're asking for like open source data feeds?
Yeah, something like that.
Well, I mean, you could set up there's a public Twitter data feed, which you can get. I think it has 1% of the hose, and you can do basic NLP to determine if they're talking about stocks or not.
But if you're interested in stocks in specific, Twitter has so much stuff.
Right.
So
I'm not familiar with a specific feed that's open source that just is about financial topics in social media. I'm not familiar with it, but it does.
Stock tweets, did you look at it?
Stock tweets is very focused. Frankly, I'm not 100% sure about their API.
Okay. Okay, thanks.
This is sort of related to the last question. What are you using for your NLP?
We are using OpenNLP. We've got some internal algorithms that have been developed over time.
All right, thanks.
Have you tried doing NLP on news feeds? Actually, I'm thinking that since that's such an old idea that, and also because there's a lot of news that is just syndicated, there might actually be less information there. So I'm wondering whether there'd be less traction than, say, these new sources of data that people are not using much.
I'm sorry, can you repeat that? Are you
Yeah,
asking?
using news feeds. So for instance, if you're actually grabbing data from Reuters and, AP and looking for sentiment analysis in the
Right.
press.
Right.
Since that's such an old idea, decades old,
Right.
grabbing information from Wikipedia edits is a new idea that maybe there's less
Right.
traction in the news. I'm wondering if you found that.
Well, I think what's going to evolve is looking at a variety of data sources, and I think each one is going to confirm the other. So I'm not saying that like traditional 1.0 analysis should get thrown out, or even news analysis, but increasingly what's going to happen is if you see a spike in news mentions for an article, that would be confirmed on other mediums like Twitter or Facebook. Which would also be confirmed on Wikipedia. So the more sources of information that you have confirming the same trend, the higher probability that whatever occurred is relevant. And I think that's going to be the main trend. It's not going to be funds or investors using one source and defending that one source as the best source. I think it's going to be much more an amalgamation of different data sources. And once you have all those data sources, then you can use traditional Finance 1.0 techniques such as technical analysis to look at pricing trends or changes in volume or changes in volatility, or even fundamental analysis on top of these, or macroeconomic analysis. So I don't think it's going to be about one's better than the other. I think it's going to be one's going to confirm the other.
Okay. I have one other question, but. Yeah, I was wondering if you can speak a little bit to how you test your models and how that might vary compared to other investment systems. Frequently you hear, well, we tested this against the last 10 years of market data. Looks great there, but of course a lot of systems don't perform after that.
Yeah,
I don't know if you can speak to that a little bit.
Yeah, that's a very good point. That is actually a point of contention, to be honest. A lot of financial models are tested over a number of decades, and that's one of the reasons why technical analysis is so popular, because you can get data going back for decades, and you can test these theories for very, very large time series. For these new techniques, you just don't have you have a lot of data coming through, but it doesn't go back very far. So it is a little bit of a leap of faith, to be honest. But anything to do with innovation is a leap of faith. And let me just go back to. So everything that I said about Finance 1.0 and Finance 2.0 and these new data sources could be 100% accurate. But if the performance of the traditional techniques are doing well, then there's no real reason to have leaps of faith or to bet on innovation, right? Because you're implying that the traditional ways of doing things are working. So all this big influx of data doesn't really matter, right? So if hedge funds were performing extremely well, then this argument would kind of lose a lot of its power. Or if the investment strategists who essentially sop up information from entire research departments were doing well, then this argument would lose a lot of its power. But neither one of them are doing well. So I think in this environment, and the other thing that I didn't get into either, but it was just a handful of years ago that the entire investment bank sector basically imploded in the US. So there needs to be more financial innovation. And if you're innovating, you need to have a leap of faith. And you can't back test for decades on this stuff. And I think what's going to happen over the next 5 years is that there is going to be a massive amount of innovation. And in 10 years' time, you're going to have all these academic textbooks and academic papers, and they'll do a lot of testing. But by 2025, the performance boost that you would have gotten would have already been evaporated, right? When everyone's doing something, you're not going to get an advantage anymore. So in order to get the boost, you have to have that leap of faith.
Oh, I missed the first 10 minutes, so maybe you already mentioned this, but what is your business model? Are you selling sentiment signals, essentially?
Yes. That will be determined shortly.
Okay, got it.
Question on the mood index. Can you describe what goes into it, and also how you know it predicts the market rather than reflects the market?
Yeah, that's a very good question. And unfortunately, I can't get into exactly what gets put into it.
But at a high level, it's the indication of all the different feeds of social media.
Yeah.
I mean, just
Yeah, it's non-finance 1.0. So there's no pricing data. There's no macroeconomic. I'm talking about structured data. So if, for example, a news story comes out or a blog mentions the stock market and analyzes the stock market, that will get quantified and included. But the actual pricing, the actual S&P daily fluctuations, or if consumer confidence falls, that information, the structured data, does not get included. Right?
Okay. So if the market drops and there's a lot of blogs about market dropping, I mean the mood index will follow the market, right? Because all the articles and blogs will reflect the market performance.
Yeah,
Right.
it's not 100% that, but
Okay.
I understand what you're saying.
Okay, thanks.
Yeah. Questions? All right, thanks.